The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome to the Morning Bell for Yellow Tunnel. I am Keith Harwood. Standard disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon and myself are not investment advisors, not registered with the SEC nor FINRA. The information in this presentation is for educational and information purposes only and should not be considered trade advice. And finally, the presenter of this video, Keith Harwood, or the team at Tradespoon may have a financial interest in the securities presented in the trade ideas. So please keep that in mind as you evaluate these ideas for your own personal trading and investing portfolios and your own risk tolerance, etc. Good morning, Ted. Hope you all had a wonderful evening and looked at MRVL this morning after watching it yesterday after the close with Vlad. It looked like that turned out to be a pretty good earnings trade so far. So we'll see how that plays out here after the open. But I'm sure Vlad will update how he's managing that MRVL earnings trade. And yeah, hope that sort of idea fit with your thought process there, as it was a nice big move right to that big volume on the 110 strike, just hitting it on the head so far. So we'll see how that plays out today, though. Really, kind of normal stuff here on the disciplined trading steps. If you guys have any questions about, the fight or flight response or compounding investment or anything like that, always feel free to throw it into the question box. Let me know if there are any stocks as well that you guys are intrigued with this morning, looking at for setups for either a directional play or an earnings play or anything of that nature. So I'll do what I can to address as many stocks as I can in the, call it, hour that we've got. Probability of success, and I've touched on this a bit with VIX dropping so much, the probability of success is certainly to the upside given the overall bullishness of the market, but also the return on capital is both expected to be lower, but there's an opportunity for it to be higher in the options market. So with the VIX dropping, options have gotten cheaper. We're expecting smaller moves out of the broad market, out of individual equities going into the end of the year. But if there is an outsized move up or down, that can create significant return on capital. So right now the opportunity seems to be there in the options market on the long side. It doesn't mean, though, that I'm looking to buy every single option I can find, because certain stocks just aren't going anywhere. So I have to find the setups that have an interesting technical formation, an interesting directional trend to improve that return on capital by getting something that's like at an inflection point, looking ready to move and has cheap options because it hasn't been moving. That's kind of the key right now for improving that return on capital and taking advantage of what the market's offering. Excuse me, got a little bit of a cold, so bear with me if I sound a little bit stuffy here. It's the joys of having small children and being all getting into that cold weather where we're all in the house more. So anyway, we are seeing a little bit of rotation out of some of the post-election winners. The last few days, we've seen some financials pulling back and tech catching back up. So we're getting a little bit of that long-short unwind. When we were looking at it last week, it looked like the market was going to continue to just rotate into financials, continue out of tech, semiconductors in particular. At least in the short term, that trend has unwound a bit. It's not necessarily bearish for financials. It's not necessarily bullish for semiconductors. But in the short term, there is opportunity seen by the market that semiconductors have lagged, so it's time to go back into that sector as opposed to buying the financials at the highs. We'll see how that kind of plays out over the next few days. I'm looking for like a bull flag type setup in financials. Look for them to start getting some strength to show that the rotation's going back into the post-election favored sectors. But I actually do also like the fact that right now the market is not just continuing to push financials up and semiconductors down, because semiconductors continuing lower could have and may still trigger a little bit more of a risk-off condition. If tech is lagging and people still have a large portfolio allocation to tech, the risk-off sometimes leads the risk back on. So instead of rotating, they go for the pure close, which is selling tech, and then start looking for buying opportunities. When you see that rotation the other way, it gets a little bit more comfort for people in the tech side. the bull can have a little bit more confidence that there's not as many individual names or sectors preparing to cause liquidation in the market. So we'll continue to watch that. Yeah, chicken soup would be a good idea, though, William. Maybe I'll do that for lunch today. Right now, it's coffee. That's the big key. Get a little bit more caffeinated energy, but I should switch to tea probably. But yeah, I mean, I think generally speaking, the market is in pretty good shape, and we're seeing the 10-year yield bounce back this morning after pushing near the lows, some support levels, bouncing back. Maybe that'll actually on its own start to drift the financials back higher. We had some pretty good earnings last night. As I mentioned, Marvel, OKTA did okay, or maybe a little better than okay. So we are seeing generally strong earnings. Foot Locker was weak, but that's not going to necessarily drive the market that Foot Locker did had a weak performance. I think MRVL being strong is big, though, as it is in the semiconductor. End of day to make trades, I think, is particularly relevant when we're going through some of these earning trades. So trying to see how the market's going to wind up prior to, because I'm always looking for a percentage type move. So if I'm looking for a stock to move 10% and intraday it moves 2%, that can shift the target strikes. Of course, the target strikes are also driven somewhat by open interest. And MRVL yesterday, it was big volume during the day on the D6 110 call. About 32,000 of those traded yesterday, mostly opening. I think the open interest is now something around 27,000. I'll take a look at that again, but really set up that magnet level and really focused MRVL on a outsized move on earnings, as the options were really playing around most of the volume on the outsized move potential. So getting that extra day of information can really be crucial and helpful to everybody. Bourbon, yeah, a little early for that. It's only 9:24 here on the East Coast, and even earlier. Good morning, Fred, as well. Last thing is, and I always advocate for this. 1 second. Not selling naked options, especially with the VIX low. It's really not a great opportunity to sell naked options. I can find better return on capital and better use of my trading capital by not using up a bunch of margin, going out and just selling a bunch of puts saying that the stock's not going to go lower. The premium is not really there. Getting defined risk by selling put credit spreads or selling call credit spreads or putting on a butterfly for those stocks that I just don't see moving, that can be a decent source of income. But selling naked options is just a recipe for high risk, low reward in the current environment. We'll see on some of these earnings if they're going to get some continuation. We'll look at some of the historical patterns on the bigger moves for them. For example, is MRVL going to continue higher and push 115, 120? Is it going to sit right at 110 for the rest of the week with the big open interest? Or is it going to use that as a rejection point, kind of toe up to it and then start to pull back as people start to unwind positions? Again, something to watch throughout the trading day. If I see a lot of activity where the stock's not moving and people are buying in the 110 call, it tells me that there's some unwind to that position and they're just taking the profits on it. And that's just as indicative of the potential for a next move as if they do nothing. Because if they do nothing, that 110 magnet really still stays. If they cover that position, then that 110 magnet is being unpacked and put away, and then we can start to just drift off of normal random walk behavior and or fundamental bias instead of being driven by some of the sort of nuance of the market structure. Keep in mind that with 30,000 open interest, that's going to represent about 3 million shares, would be kind of locked in at that 110 strike. Okay. So with that, let's start with TNX. The 10-year yield bounced. So really the range right now seems to be from 4.15 to 4.5. Post-election, we just kept going up towards 4.5. Started to create some concern that the 10-year yield was going to get too high. And then we rejected that. And then as we get down to 4.8, to questions about whether the market rotation is correct. With lower interest rates, maybe it's time to say, that it's not as clear that we need to be selling tech and buying financials. Maybe it's the other way around. With the bounce back today, that could start to just resume some of that rotation. Although to start the day, looks like tech's on the firm side. So that's not happening yet today, but it's definitely something to watch if interest rates continue to be firm. Keep also in mind that we've got non-farm payrolls on Friday morning, so that could be an input to the market that creates some extra movement. We may or may not see that, this week. I don't know that anybody's expecting non-farm payrolls to be particularly impactful, but it always can be. And yes, I will definitely look at Amazon. Yeah, okay. So Amazon's on the list. I'll write it down as well to make sure I don't miss that one. Bitcoin, one of the other big post-election winners, towed up around that $100,000 range, and now it's consolidating. So we are actually getting into tightening up into a point of inflection. As you can see, we're lowering the high and raising the low. So this creates a wedge. As we start to break out of that, if the sellers get less aggressive and the buyers get more aggressive, it pushes us up to 100,000, and then we see how we handle that price point. If the sellers get more aggressive for profit taking and rotating out of Bitcoin, I think it could push us back down to 85 or even 75. So I want to watch that very closely here in the coming days as we are getting the spring coiled up, and it looks like the technical situation needs to be resolved in the next day or two. Maybe it actually gets resolved by the data coming out from the economy and the non-farm payrolls on Friday. Maybe Bitcoin actually can be one of the bigger movers off of that. But that can then set the trend for all those crypto-related stocks, the MSTRs, the MARA, RIOT, BTDR, etc. So I want to watch that very closely here in the coming days. It's not a trade yet, but I want to be prepared to know that if Bitcoin starts to break below, say, 94, 93, it starts to get some question marks. The bounce back today pushes us into a level where, relative to yesterday's low, we're kind of hanging right at yesterday's close and not going anywhere. But if we start to push a little bit higher, then that sets those up for potentially higher prices. And that's the more exciting setup because those have generally been parabolic when they go. So I will be intrigued by that, and I'll be looking for something there if I get the right leverage for it. And then as we see the VIX drifting down here, towing around 13%, just above it right now. You can see that the low was 1305. Here, I'm going to switch over to live vol now that I'm live here with the markets after 9:30, and you can see the VIX 1311 right now. The lows here. Let me see if I can do a weekly on this just to make it a little cleaner. Like the lows, maybe we get down to 12% here in the coming weeks as we go into the holidays. That would not be surprising to me. So there's limited downside to the VIX, but there is still a little bit of downside. As options get cheaper, that does, because it means that people are selling and the market makers continually need to hedge. But if they push it down too low in individual names that have interesting technical setups, that's an opportunity. As I've said before, skew drifting down as well. So people aren't necessarily getting aggressive with buying extra puts to ensure their portfolio into this drop in the VIX. It looks to me like they're basically just kind of selling everything. There may be some naked put selling. That's a dangerous thing for the market, but I don't think they're out of position right now in terms of just naked being short puts. More likely, you've got some people that have bought a few put spreads, others selling straddles, putting on naked shorts here and there. But with the skewed exit was lagging a little bit on the VIX drop before. So I kind of believe that over the last couple of weeks, people have built up a insurance on their portfolio, covered some of their puts, bought extra puts to hedge for a downside, and now we're positioned well to just do what we're doing, which is drifting higher. New high today in S&Ps. Looks like it's just wanting to continue to go. There's not a lot of fundamental inputs that look like they can derail this market that are currently being priced into the market. So there's not a lot of unknowns that are concerning to the market yet, i.e. we're not showing any real concern about non-farm payrolls on Friday. We're not showing any concern about the Fed on the 18th. We're just showing that the market can do what it likes to do at the holiday season, which is drift higher. I'll end with tech so I can go straight into Amazon. Small caps bouncing back. So that's good to see with the 10-year yield a little bit higher, small caps a little bit higher here. Really showing 240 roughly as an interesting support level that's starting to form here. We tested the November 26th and December 3rd lows. This dip, these were pretty, by the end of the day, got to okay volume on the drift down, but it wasn't anything to write home about. This was not a major volume pullback by any means. When we look at financials, we did have a little bit more significant pullback, and they are slightly weak to start the day. If small caps continue to stay firm today and the market stays firm, I would not be surprised to see financials get a decent bounce back. So that's something to watch for, looking back at some of the big winners and the best performers initially, JP Morgan. And I particularly like Wells Fargo if interest rates are going to start to rise again, as they've been a big winner off of this new post-election regime expectation. So Wells Fargo, certainly one to watch here. I don't like the fact that it's a new low relative to yesterday. I don't like the trend of the last 3 days where we start at the highs and close at the lows. So watching that intraday price action and seeing if we continue to have sellers throughout the day is going to be really indicative of whether we finally reach that level that buyers resurface. If we start to push towards 74.5, 75 intraday in Wells Fargo, I think it sets up a call buying opportunity. You can see here that the implied volatility in Wells Fargo is near its lows. Even when it was low before, we were still getting good movement around the 20 volatility, and right now we're at 23%. So it's not mispriced too high, maybe not particularly too low, but I can just go into January, buy a slightly in the money call, like a 72.5. And if we retest the highs, which are at 78.10, I'm already well in the money on my trade. 72.5 for $4 at $78, those would be worth 5.5. So I could have a 40% appreciation on my portfolio or on this individual trade, not putting my whole portfolio on it by any means, but I could have a potentially 40% return on that trade in a matter of a week if Wells Fargo finds that buy or finds that support now. All right. And I should touch on two more on the financials. Morgan Stanley has been a little bit weak, relatively speaking. So that's one, though, that I want to watch, because if Morgan Stanley starts to get some more interest and bounces back towards the 133 level, it may be positioned for a break out to new highs. And then BK, because I had added it last week off of some aggressive power trader and weekly power trade, the exit for me was lined up for Friday. So the way that I normally try to do those is a very short-term holding period. But now, as I see this little drift back, I am starting to look for this, very similar to XLF or Wells Fargo, saying that this pullback was not an extreme volume, but as long as we don't repeat that trend of starting at one level and closing on the lows, so the highs of the day being made on the open, then it shows me that that market is really, really ready to buy. And yes, Fred, I will definitely touch on Uber here as I switch to tech broad topic here. So tech, good today. I think a lot of this is driven by Marvel, which now blew through 110. So that's a interesting starting point for it. Didn't stall too much at the 110 line. We're building some volume on 110, 115. Looking to see if there are any big trades here in the December 6 weeklies that are relevant. And nothing really crazy yet. So just I got to watch this throughout the morning. If we start seeing aggressive buyers of the 110 call, it may mean that there's some continuation here while staying above 110. If we don't see aggressive buyers of the 110 call buying in that 27,000 open interest, 2.7 million shares worth of stock, then this may start to consolidate. But it's something to just kind of manage now. Good trade to get to 110. Little bit hairy getting a little through it, but at the same point, right now, it's not a bad trade by any means on the double fly for the earnings traders there. That's a benefit to semiconductors. So we're seeing semiconductors continue to lag. We're not near the new highs yet. And, overall new highs would be 285. we're over 10% away from that. But if that can start to catch up and Marvel can help give some, oomph to the semiconductor sector and some more interest there, that's nice for the tech side of things. And so since we said Amazon first, so Amazon is now breaking out. So good eye on that, Pam. I see, Amazon, I was really looking for that above 215 to start showing that it was not going to just have a double top and then reverse. Today looks really strong. I like the fact that it's sitting a couple of bucks above, so we've got a little bit of room before it would start indicating a false breakout. Apple on the strong side as well. Okay, that's good to see. So let's see the options market. It's about as low as implied vol gets. We can get down to 22% maybe. Currently at 23. And so for up to 3 weeks, I'd be in like a January option. They're not bad here at 24% implied volatility. It's not, and I don't see a justification for the premium's just not there unless I'm doing something fully out of the money, like buying a 230, 240 call spread. Then on a relative basis, the debit spread makes sense. From here, I tend to prefer something on the near at the money when going for a trend with implied volatility low. That would lead me to looking at a 215, 220. If I'm looking for a longer holding period, the option of holding through next earnings and saying fundamentally this has got a lot of room to go for a while. March or April, let's see. I think going into March at a very small premium on the implied volatility, only about 0.5%, probably makes a little bit more sense. That implied volatility will naturally rise as we approach earnings because the days of 24 vol are priced into that, as well as the 1 day of, what's our normal move here? 7%. So for that day, 112% would be the norm. That'll be a bigger factor as some of the days of the 24% that we're seeing for December, basically go off. It's a bigger move than the normal moves today. Normally pricing in 1.5%, already 2% today. But going into some of those March, probably looking more of a call spread. I mean, this 220, 235 that somebody put on today doesn't look bad. I tend to, on my call verticals, look to sell around the 30 delta, not a 40 delta. So I'd probably be looking at 240 or maybe even going as aggressive as 250 for the big even number. That's a long way to run. We got 25 bucks in a month with a little chop here. So it's not overly crazy to think that 250 could be in line here. So if I go with like a 50 delta call and selling a 25 delta call, that's not a bad spread type trade. We do need to get price appreciation for that to come in the money. 225, 250 is currently around $7.50. So my break even point is 232.5 with a max value of 25 bucks. So I could, in theory, triple my money, but to actually achieve that, I would have to hold through earnings. So I think for me, I prefer just letting the trend run out through the end of the year and going for January, like 220 calls and riding that momentum. And not exposing myself to the earnings. I'm not even tempting myself with the earnings by going into the March options. And if I change my mind in a month and I want to have that exposure through earnings, I can always rotate my position. But I think I like starting myself off with January, just out of the money, 220 calls. I need to get to 227 to break even. So the break even point is still needing about a $10 appreciation. But 3 more days like today and we're there. That's it's about a 3-day kind of move. So 1.5% is $3, and I need about $10 to get to my break-even point. But I do like the jump today. RSI is not overbought. We had the MACD crossover a little bit here. And then it's just managing the timing on the entry. If we're going to continue to get buying throughout the day, it might be something that I end up missing as a result. But as it currently stands at under $7, the JM 220s don't look too bad. And then Uber. Let's see what we got on the stock. So similarly, earnings in February. We don't have to worry about that too much on short-term technical. So we got a bit of question mark on support here. So there should be some support right here at $70, this low from earnings that we tested a couple of times before breaking and then bouncing back. We're testing it again here. To give me a real bullish signal, I need to get above these 73.80, start showing that these recent highs are no longer resistance. And then it can start to get towards 80, I think. But at the current time, I'm leaning on the bearish side, especially being down on a generally bullish tech day. Q's now up. What percent? About 0.6%. So it's not huge, but it's a part of the buying crowd for the tech type side. How's the implied volatility here? Yeah, at 6-month lows. No surprise here, like I said. With the VIX as low as it is, just about everything is going to have implied volatility at the lows. Does 67.5 hold if we break? That is one big question mark here. If we close below yesterday's low, I think that's where I'd start looking at a outright put. The real support in the options doesn't kick in until about 65. There's some, 65 is definitely a much bigger level. There is some 67.5 interest here in December, but not much in January. So, I mean, a simple January 70 put, that's still a winner. If I get this for under $2.50, if it happens quick, the implied volatility rises and gives me a little bit more of a premium. You can see here, like the 72.5s are already $3.50. So if we drop $2.50 to 69 or just below, these should be around $3.50, maybe even a little bit higher, because this implied volatility should rise into a sell-off. So with the implied volatility low and light support at 67.5, if we are going to close lower on the day, that's where I look at Uber. On the bull side, I think it's just a wait and see. I think you're right. So if you're thinking buying, I'd probably hold. How's Lyft looking on a relative basis? So Lyft is showing some relative strength there if you're liking the rideshare space. The bull flag here with the pullback, and then today having a higher high and a higher low. You can see the sellers have been getting more aggressive, and we're testing against that aggressive seller right now. So they've been lowering the level that they're willing to sell, now pressing against it, continuing through, sets up to 19 to then be the next inflection point. So I wouldn't necessarily go for the 19 calls, but just into the 17.5s. That would then be making money. If we get to 19, I can then reevaluate and rotate my position into the 19 or 20 calls for the breakout, or take my money if we stall at 19. But I think Lyft looks better than Uber overall. Nice. And I have no new positions yet this morning. I'm going to keep looking and deciding here, but I have a couple that I've got on my list to look at. Nice, looks nice here. So we had the earnings gap down, the recovery. Now it looks like it wants to fill that earnings gap. So we've gotten above the earnings high. We got above these recent highs as well. That kind of positions for a look towards 195. Which country are they out of? All right. Yeah, so it looks pretty nice here overall. Markets are wide on the options, so it may be better as a stock trade. Implied volatility is not particularly low. And you can see $1.20 wide spreads here on the options. It's all about like kind of nuancing the entry. But January call spreads, I'm wondering. Is we targeting 195, or actually a safer trade might be an in the money call spread, like a staying above 180 trade here. Yeah, the D's 180s have enough premium. Yeah, like a 170, 180 put spread looks to be around 2.25. So that would mean the call spread should be about 780. Yeah, looks about right. So like maybe 780 for the 170, 180 call spread. That could be an interesting way to do it. If you're really bullish, maybe looking at the 190, 195 call spread for Jan. So buying near at the money and then targeting this previous, the low on the day before the earnings to just completely fill that gap of trading volume that didn't exist. So we went from from effectively 200 back down to 185 and then chopped around down here. So somewhere between 195 and 200, we should find a bit of profit taking on that recovery. So I'd look towards call spreads in general here. And I think that if on the bull case, like the optimistic case, like a 190, 200 call spread, and the conservative version that actually has more risk technically, but it's built off of this idea that support should hold, a December 170, 180 could just slowly appreciate in value towards $10. All right. Let's run through the active. So CME broke out yesterday. I'm wondering if we're going to kind of follow a little pattern here of breakout, couple of days, then breakout, couple of days. CME does look interesting here. If exchange volume is decent, CME does well. Overall, implied volatility is kind of on the higher side. So it looks like a call spread. There's not enough premium on the 230s to go in the money with it. So I think I just had time here. Get like selling options for $1.50 and a $250 stock. Let's see what the rate of appreciation has been when it's had a trend. So from August 6th till September 6th, that 1 month period went up about $20. That would put us at 260 if we repeat that. But if this is the starting point of the trend, then we're looking at 250. And that leans towards, I think, just those standard Jan 240s, doubling money type trade. I don't want to get too aggressive with like Jan 250s if that's a bit more of a coin flop, but I don't want to sell the 250s either because we could go up to 255 or 260. So I think just an outright 240 there. TWLO. RSI is just jacked in Twilio and has been for a month. I hate box 70, and I just have not had a ton of success trying to buy stocks that are already overbought. Obviously, everybody that's been buying it while it's overbought is doing just fine. The MACD is questionable here as we're starting to slow down the rate of movement. This one for me is a hold off, maybe onto a dip like what we saw here a week or so ago, where you get a little bull flag here. That could be a better entry point. But for me right now, I think I'd hold on Twilio. And I know Vlad added Citigroup yesterday. This is going to, I think, be built a little bit off of the financials. If financials get some buying action today, that can be a interesting add point. But really, it's similar to what I was talking about for XLF, WFC, etc. If we are pulling back throughout the day, it means that the selling in financials are not over. I want to see us close near the opening level or higher rather than closing on the lows like we did the last 2 days where we have these decent sized red bars opening around unchanged and then dropping, about 70 cents. Opening higher and then dropping around 70 cents. Opening unchanged. I don't want to see us drop another 70 cents here in XLF, as that would be an indication that there are still more sellers than buyers. So I need that signal that the buyers have returned. So that's it for Citigroup for me right now. One that I'm looking at right now a little bit closer, and I said yesterday that I'm a little bit jilted by it, I guess, after looking for the breakdown to chase Philip Morris. But now, move on. It's been a month. I can be okay with you again, Altria. So we've had some signals on the long side in Altria recently. I had a long signal yesterday, had a small pullback, and what I'm seeing to start this day is that the buyers are starting to return to Altria. So we started lower. We're bouncing back. Yesterday's low is 56.83 and the close is 56.90. So I think if we turn green today, that's going to be the big thing. The high today is right there, just below yesterday's low. Current pricing on it. But there's a good amount of leverage in just like the January 55 calls for 215 to 220 back to 58. Those are worth at least $3. So this has got some good potential here where I could get a 40% return just on a retest of highs. And if I'm getting AI-based signals, and I'm getting positive signals in the technicals for separate evaluation, it starts to look interesting to me, but I do need to see a little bit more appreciation here today, a little bit more buying behavior. So call it 20 cents higher than now. These calls will be 230 to 235. That's where it gets interesting to me. And so that's what I'll be watching for in Altria today, is just setting an alert for unchanged on the day and seeing how the market's handling this overall trading day and this little drift down. Because effectively what I'm looking for is a signal that we're getting a bull flag. A little bit of profit taking followed by buyers. All right. Let's review $30. So the average move is about 7%. Now we're up to about 10%. We had kind of an all over the board, anywhere between 3 and 20% moves. Just on the option space, we didn't have a real defined target strike here. We're anywhere between 1,500 and 4,000 open interest, all the way up to 380. Tons of volume today, though, on the 370 line. Looks like people are trading for the continuation side of things. To be seen, to be determined. For me, I don't see anything obvious for this week. If we start to see some consolidation here up after the earnings gap and start to set up a continuation trade, may be more interesting. I don't know that I would want to trade for the pullback, even if that starts to become evident. Okta is doing the pullback. Wow. So Okta looked really good this morning, was pushing through 90. It's looking like it wanted to fill that earnings gap, and then just this major pullback to start the day, almost, effectively unchanged for Okta. The normal move on earnings is around 13%. And now we're down to only 4.5%. So the opening price was in line with the average earnings move. Now we've got kind of a non-event, one of the smallest moves. I'm going to look at this NTAP because it kind of reminds me of NTAP, where we gapped higher and then pulled back. I wonder if MRBL is going to try to retest lower on the day. Sorry, if Okta is going to test lower on the day before it can maybe resume the upward trend. So, right now, there's not a target strike. A lot of it's on the upside calls. Looks like some people got real aggressive with those on the open, and then we just rejected higher prices. So let's watch how this goes throughout the day. If we can start bouncing back towards 88, getting into this near the 200-day moving average and kind of back near where the gap open was, that starts to set up maybe bullish in the coming days. But for now, I think this is another one to just kind of hang off on. And MRVL is continuing. So big volume on the 115s, people getting aggressive here, buying in some extra calls. The implied volatility's got some room to fall, but man, we are just cooking here. So MRVL, when I look at the intraday for this last couple trading days, and I want to do a 5-minute chart. So you can see we opened at 112, pushed, and then I start using some of the same evaluations of my daily charts here on this. We had some good volume on the open with the buyer, and now we're consolidating a little bit with a little lower volume. But if we push to a new high, this looks like it could just go for a while. There's no real resistance above. We don't know where the next real seller is. Wonder if more rumors about the CEO leaving for Intel would actually be the only thing that could stop this at this point. But I did want to point out that this was an $83 billion company yesterday, so call it a $100 billion company today, and Intel is a $97 billion company. So it'd be a lateral move, barring a big raise for him if he actually did decide to take that. So, yeah, in general, it looks like MRVL profit taking that may even turn it red, and that's a little concerning to me. MRVL, I wouldn't necessarily trade for the 110 pin. At some more aggressive pulling back to the 110s, selling of the 110 calls, and right now that's just not what's happening in this market. So if we start seeing aggressive sellers of the 110s to help pull it back down towards like 113, then I can start thinking about the pin again. As it currently stands, it's undefined where I think the pin would likely be. The open interest says 110, but the stock says 115. So not a clear signal there for a short-term trade for the rest of the week. The two this morning that were a little nasty were Chewy. So, Chewy didn't do great off of earnings. I usually think of people as not being particularly price sensitive on their pet foods and things, but apparently it wasn't enough to keep Chewy going. So we do have a smaller than normal drop today. Normal average is about 10%. We only dropped 7%. I was looking for potential. That doesn't mean we won't get there, but right now you can see like a 32-30-28 put fly. Does still show some interest to me, as this open interest is much more on the 30 line. We have bounced back, so we tried 30 and bounced off of it, but I wouldn't be surprised to see us retest that level here. So a butterfly to hold through expiration and then close Friday, targeting 30 and Chewy. And like I said, it would be like a 32-30-28. And then Foot Locker, 20 is the number. The options about as big as we've got here. It's not huge open interest anywhere, but 20 was kind of lined up with the normal earnings move here, 15%. We're now at 14%. Kind of bounced, tried below it, bounced off of it. I'd say we probably, I'm going to expect that we're going to stay between about 19.5 and 21.5. So technically that would be like an 0.5 strike target. Targeting 20 can also work for the slightly more bearish thesis. So I think probably looking to be a little range bound here, but with a range of expecting to stay between 19.5 and say 21.5, I can lean a little bit bearish with, again, a 22-20-18 put fly. That right now is trading, let's see, 75. So call it 75 cents. About 75 cents for the put fly. And it's profitable under 21.25 and above 18.75. So kind of right in my range. And that doesn't look too bad for this week right now, given how the earnings played out in Foot Locker. So, there are two approaches to some of these earnings butterflies. You can put them on ahead of the earnings when the leverage lines up. And then for those that didn't get put on ahead of time, there's still an opportunity. It might be slightly more expensive, but I'm only looking at the put fly now instead of the bull scenario. So at least I've cut off half of the trade I would have to do. And then I start targeting that $20 price point and seeing if I can ride out a little bit of a chop downward here for the next 2 days with the fundamental input known and the market just digesting. So I like keeping that in mind as we go through this. Like with MRVL, that 110 strike doesn't seem like it's becoming the magnet. So I don't want to get into that new call fly as a new position right now. But Foot Locker looks like 20 may be working pretty well for me as a magnet. And if we start getting above 21.5, then that trade theory would be negated a bit. But $20 seems like a decent price point. Yeah, so for Chewy, it does need to come down a little bit more. 30 price target. So, it kind of looks similar to Foot Locker here. It tested 30 and then bounced. Yeah, and that's, I mean, still where the open interest is. So, it's similar to what I was talking about for Foot Locker, like a 132, or sorry, 132, a 32, 30, 28 put flight as it currently stands is about 65 cents. That's not a terrible entry point right now for where it's at. I wouldn't necessarily look to close it because of the bounce off of 30 yet. If holding from before earnings, I'd probably continue to hold at 65 cents. It doesn't look overpriced to me at all. If it was trading around $1, certainly becomes a little bit more questionable. But at 65 cents, even 70 cents, there is still some appreciation that can and maybe should happen as long as the stock doesn't just start to skyrocket higher. So I like the theory here on 30. It does line up with a lot of that consolidation. The bounce back today is not the worst for it, but I don't want to see much more bounce back from here. Back above 32, 3160 here was this low. Getting above those sort of levels starts to tell me that people were fine with the earnings after all, and they're just going to buy up this dip, use it as a buying opportunity. But right now, it doesn't look like that's there quite yet. Little questionable. Foot Locker, they're buying a little bit more now. So, all right, are we buying everything? Is that the issue? No, I guess just buying those two off of the dip. Okay, for now, unwinding the move. So is Okta still down, dropping? It is. Okay, so completely unwinding those three earnings. Chewy and Foot Locker buying the break, and Okta selling this rally. It is looking like it's turning into NTAP again. Bit surprising to see that reversal on it. I'll watch that though in the coming days, because if it can set up like NTAP did, maybe this is actually just going to coming days. Probably not today. Micron didn't pull back nearly as much on day one, but after a week did. What did Home Depot do? It took about a week and a half before it started breaking out. So just looking at some of these other names and how they behaved after their pullback from a bullish earnings trade out. Yeah, it's still above. Let me see. Making new highs here. I'm looking for that point where people come in and start selling, and we're just not getting aggressive sellers yet. There was some on the open. Then we had a little chop and then a breakout. So basically set up a really tiny bull pennant there, broke out. I'll just do it daily then. So we drifted up, found a little bit of profit taking, and then now drifting to a new high. Profit taking yet on this move, and really not seeing aggressive volume in the last few bars here. Let me see the 15-minute on a 5-day again. So this volume was around 3.5 million. So still high on the volume, but not crazy. For a 110 pin theory right now. Yeah, they got big. They got aggressive with these now. The 110 started getting traded out here at 670 in 500 lot clips. Looks like it was a buyer. So the guy that had sold all those 110 calls yesterday, the 30,000 of them, looks like he's covering them at 670. But he's not going out and selling the stock with it yet. He's buying them basically right here. The stock is stalled. So if he was a buyer right, he has just now bought back his stock or bought back his calls, and he's riding the stock for now. The question mark becomes if he starts to aggressively sell his stock out. If he buys 27,000 calls to sell 2.7 million shares or a portion of his stock position, that could be what can stop the movement here. But given that we're getting into the $2.5 million or 2.5 million shares every 15 minutes as it currently stands, he can take off his position without completely stalling the market. He'll just slow it down. But if it wants to go higher, if there's no other sellers, when he's done, we can keep going. What my guess would be and this is sort of just a pure educated guess, is that he covered his calls and he's going to wait to sell, and may sell some, if not all of his stock later today. But initial move was to buy back the calls and then kind of leg out of his trade. But until we get below, I'm not necessarily looking for a 110 pin. And if he's covered here and the open interest goes to effectively zero, done with the open interest being a magnet from a pin perspective. Yeah, he's still coming in here. You know, you see little 500 contract clips going in here and there. Let's just do this. I'll sort it by time. So you see these, you know, couple hundred at a time now. He was buying 500 at a time. Now we're getting just smaller volume. I have a feeling that the guy that did all the trading on those before, you know, the big volume yesterday, selling those 500 at a clip, that a lot of his trading was done here with these. Let's just show you how many 500 lots were covered here. Right here, you know, all these 500 lot clips at between 6.5 up to 670. That's likely to me that the guy that sold those yesterday got out of his position. And if we get rid of the position, now you just have a clear board and you don't have the magnet anymore. So Marvel can now just drift as it wishes, and set up somebody else's trade instead of the December 6th option guy trade. So unfortunately, I think that makes this not an interesting one for me for the pin anymore. It may still do it because we did have 11,000 puts trade that are new, but I don't have a strong bias on that pin after the action that we had this morning. We've now got spread open interest between 110, 115, and 120. That's moving now. So had a couple others moving this morning. Said what's moving now, might as well pull up now. What do we got there? Up 4.5%. Wow. Now, that one, with the new high, it just looks bullish, but I don't have a strong directional bias on that one. I want to go back to my Under Armour thought from yesterday. So with Foot Locker a little weaker, that may be dinging, you know, some of the other retailers in the leisure and athletic space. So I kind of think that this will probably be the one trade that I'm looking at the closest for this morning is Under Armour. So I mentioned yesterday, UA was the signal that we had an aggressive power trader. We don't have weekly options and we don't have dollar strikes. They basically go in tandem, but it's got $2.5 wide strikes and it's monthly options. So UAA, I can get a little bit more fine-tuned in my execution. So I got $2.5 strikes for the traditional January options. If I go to the prior weekly, I've got dollar strikes. So the markets are still a little bit on the wide side for some of those. They're priced out in nickels and dimes instead of in pennies. But if I'm looking for something here just to work into, I like 10 as a strike. I would have liked 9 for UA, but they only have 7.5 or 10. So just going at the money in January with these 10s for mid-market, if I can get filled on those for 70 cents, you know, I'm looking at this as a potential to get back and retest this post-earnings gap up level in the 11 range. And if things go wrong for it, you know, another dollar and change down seems likely. But on the bull case, I think that I'm going to have to look at that once I see some intraday buyer here, maybe pushing us back towards the 10, around 10.15. So 13 cents higher, showing that there's some buying still. There was good volume on the open and then nothing for the last 45 minutes. But if I start seeing some volume pushing it back towards 10.15, I think the January 10 calls look interesting for Under Armour. Ooh, is Netflix running this morning now? Yes. So we've got the trend. We have the ascending triangle We are making the new high today, pushing through the previous high. So the ascending triangle is the part where we've got the rising low and the flat high. This looks bullish. If a stock ever look bullish, the MACD is not crossing over. Everything's setting up nicely for this. The options are extremely expensive because it's a $900 stock. An at the money call in January is $4,000. So I look whenever I see something like this, I just start looking at call spreads. $4,000 is just not realistic for many. I don't want to say most. Everybody's got their own current financial situation, but if I was trading, let's say it was even off of a $50,000 account, one contract for $4,000, $2,000 or $3,000, that's a pretty large risk on a $50,000 account to put $3,000 at risk, right? It's 6% on one stock with a time crunch on it of only a month and a half. So if I can get into a spread position or take advantage of this support at 860, what if I looked at 2 weeks out, the 860 call spread? I only get $1. Let me double check this real quick. It's not enough money, I don't think, to do the in the money call spread down at 860. Is there a higher level that I have enough confidence in? 860 is the real confidence, so it's a high probability of making 10%, but if I'm looking for a little more bang for my buck, I can get a little bit riskier here and go up to 880 support. That'll be a lighter support level. The 870, 880 call spread should be trading for around, I can have a potential for Netflix. The conservative play is in the money debit vertical call spreads, which is synthetically the same thing as a put credit spread, but just so that I can see the cash out of my account instead of having the margin side of it. Doing the debit vertical can sometimes make sense. Very conservative is the 850, 860 based on support, but that's also going to be the technically highest risk relative to the reward because it's technically risking $9 to make one. Just a high probability of success. So that's the probability of success trade. Little lower probability of success to improve the return on capital is 870, 880. And if I want to hold for longer, Jan, I'm thinking going to like a 920, 970 call spread, so like $50 wide. And that's going to cost around $19. So, sorry, 33, $17. So $1,700 for the one contract, but it could be a way to get some exposure here with some leverage. Trading at about 30% of the max value of the spread and the max value and move to the next trade. But I do like the way that Netflix is setting up here. One bad day and then resuming the trend. It just looks really strong. How's Tesla look now? Yeah, so that's got to get through 360 to get exciting again. That's the wall it's facing against, so nothing there. And we looked at Amazon, and that's continuing here, so that's nice for Amazon if we're in it, or if you're in it. Earnings for tonight and tomorrow. Let's do those real quick. AEO is tonight. American Eagle. You can see it's generally underperformed. We've had an implied move of about 10%. We've had ranges between 2 and 12. I don't see a ton in here. It is a $20 stock. If it does 12%, it becomes an $18 stock, which seems like it should provide some support. So if I want to bet on that, that would seem somewhat interesting, but there's almost no open interest here. So just wanted to touch on it as basically, I don't want to spend too long on a trade that I don't think is worthy of anything personally. Dollar General. So remember DLTR just had their earnings. September 4th was very bearish and it went down 22%. Dollar General, August 29th was very bearish and went down 30%. So they do seem to go pretty closely correlated. November of 23, maybe the outlier there, where it was bullish for Dollar Tree and slightly bearish for Dollar General. But we're seeing today Dollar Tree up very small. Last time we did that was maybe the March 1st, could be our analogous term. So I'm thinking based upon this move and this move that we're right after Dollar Tree had small positives, that maybe leaning towards a smaller move in Dollar General than the market's currently pricing in makes some sense. So you see that they're building an extra premium because of the move last quarter. We had a very small move in Dollar Tree. We've had a ton of consolidation in this area. If we just get a small move and stay within, say, 5% of current stock prices, between 75 and 85, for example, I can generate some premium by doing what we were talking about before, where, I sell a put spread and I sell a call spread. It's an iron condor. Take that as a credit. And if I can get enough premium for it, I can actually have a pretty good sized leveraged return from selling options rather than having to go out of the money and pick a directional move. So, the example would be if I sold the 75-73 put spread for 70 cents, and I sold the 85-87 call spread for 55 cents, I'm collecting $1.25. So I'm collecting 62.5% of the max value of that spread, and betting on it doing something similar to what it did last time Dollar Tree did nothing, staying under 5% move. So if I can get that correct and we move less than 5%, I make $1.25. If I'm wrong and we move 10%, then I lose 75 cents. So this is one of those spots where I actually look for this to be a less volatile move than the market's pricing in, and thus not looking for a butterfly targeting either direction, more saying, I expect this not to move this time. So I actually like Dollar General for the iron condor there. And like I said, I think between 75 and 85 makes some sense. 75 is just above the previous lows are around 73.5. The previous highs here around 85. If I want to be a little bit more conservative, I guess, go into a 73-71 put spread, get 56 cents of credit, and get 60 cents of credit right now in the 85-87. So it gives me about $1.15, and it's a very similar, similar concept, just slightly different premium amounts depending upon how aggressive I want to be with it not moving. So it slightly changes the return on capital element of it, switching from $1.25 of profit to 75 cents of risk to say $1.10 of profit and 90 cents of risk, but increasing the odds as I do that. So that's the benefit of shifting those strikes down and further out of the money, is it improves the odds of success. But it's very much built on the concept for me that correlation-wise, Dollar General tends to move small. When Dollar Tree moved small, Dollar Tree moved small. Now I'm looking for Dollar General to have a smaller move as a result. Kroger, it's 3% kind of mover. So we're talking about a $1.50, and that doesn't particularly excite me. I mean, yeah, we can go to 61 and retouch the highs, but I think the fact that it doesn't excite me is similar to what the rest of the market's saying. Not a lot of open interest, not a lot of desire to trade that. The final one I wanted to look at is Signet, because this is a mover on earnings. It has been pretty volatile, right around 11%. We've had a couple of smaller moves, but generally in this 11, 12, 13% kind of range, we're pricing in about that this time. And if I look at 11% here right now, let's call it $10. That puts me down to 88, 87. So just below the support level at 90. We'd be looking down here at the post earnings. And then on the upside, 107. That's pretty lined up here with the previous high of 106. Into the options market, there's not much there. So there's not the magnet side of it. On the downside, there's open interest at 94, but I don't expect that to hold anything necessarily. I think if we get bearish, we're looking down here into the, I'm going to say 87 range on the downside, and 107 on the upside is potential targets. And then again, just going through the same process, 92, 87, 82. It's not particularly tight market. So I've got to do a little bit of work on mid-market execution so that I don't overpay for it. But if I can get mid-market execution for 305, that's a quarter cent. So about 55 cents on the put fly, should be about the same on the call fly. So call it a $1.10, $1.20 range for the double fly. That can pay off really well if we get our traditional 10 to 11% move. So Signet looks kind of interesting for the targeted move, even though there's no open interest for it. Dollar General to me looks good for the let's expect less movement than normal. So that is about what we've got here for the morning. Take a quick look to see if some of these banks are, so they're doing the same thing still. You can see BK weaker from the morning. XLF continuing with weakness for the morning session. So it's kind of repeating that pattern so far. So I don't like financials yet. I want to like financials, but that drop up until about 11 o'clock and then yesterday up until noon still seems like we're doing that for the time being. So I got to find those buyers to stop the seller of XLF. SMH holding out okay. Good. We'll do another check here. Yeah, Marvel still pushing. Chewy. Yeah, okay, maybe finally stop bouncing back. We'll see. Foot Locker still bouncing back. So Foot Locker no longer looking too good for the 20 pin, I don't think, but we'll see. If that can start to reject and set up a bear flag, that would be important, but there's no downside yet here. It's still got buyers. XLU, yeah. So XLU is starting to show some bottoming action here. It's a big pullback for 2 days. It's not in that easy buy at trend mode right now with interest rates coming back up a little bit. Let me double check the number right now on TNX. See if that's shifting at all here in the last hour. Okay, so you can see it was 427 down to 423, so that's drifting down a little bit. I think that's part of what's been hitting utilities is that, or shouldn't be hitting utilities. So, the bounce back should be hitting utilities, but the fall in the interest rates shouldn't have necessarily hit them. If we're looking for dividend yield, since there's no interest rate yield, but maybe it's just a lagged response here overall. Is Altria? No, Altria is still not ready to buy in yet. NEE has been like a problem. Here we do this. XLU components. I don't know these websites, but NextEra Energy is 12.78%. Southern and Duke are the top three. And you can see NextEra Energy looks really bad. Southern looks really bad right here. Duke has looked bad. Okay, and it looks kind of bad here again too. So utilities seem to be getting held up. I'm not sure what actually is keeping them up as high as they are, given where some of these. So I'm a little leery of utilities until we start to see a real bull flag. So we're seeing a better performance today than what we're seeing in financials. So we were opening on highs and closing on lows. Today it's holding up okay, and it's up small. Given what I'm seeing in NextEra and Duke and Southern, I think I'd rather wait till tomorrow and actually see the higher high and higher low than the prior trading day to get long in utilities. From here, once that happens, I'm just targeting 83, and then it's about finding that utility that I want to get into, whether it's PAG or maybe probably not Constellation. Although Constellation has a bit more of a bull flag type setup right now. PEG would probably be one of my first thoughts here, since that's been generally one of the leaders. Dominion doesn't look great. What else did we have that I'm missing here? AEP maybe, XEL. XEL could be a decent one if it gets a bull flag. It's not there yet. Exelon, no. BCG. So I think PEG right now would be my pick. in the utilities once we see a bull flag. All right. All right, folks, that is 10:30. And we'll talk through more of these setups and these ideas. So best of luck this morning. I hope you guys have some good trading, and we'll talk tomorrow. And I believe Vlad's on for the close today. I'll double check with him, but somebody will be on for the close today, but I believe it's Vlad. Thanks again.